we say debt and you envision an expensive vacation, a new house, or a fancy car. You get charged thousands of dollars by the credit card companies along with hefty interest rates. This situation appears to me as a house of cards that could come stumbling down at any minute. 70% of Americans are swimming in debt, striving to get out of it. Guess where they used this debt? Most of the debt money was used to pay the car loan debt, the student loan, or mortgage. For most people, it takes years and years of hard work to pay back the loan. This makes the masses believe that debt is a bad thing. People would rather not borrow money than stay in debt. However, the wealthy see debt in a positive light. For them, it is sort of a tool they use to build up their wealth. In other words, the wealthy see debt as free money. I'm not even kidding. The wealthy use the borrowed money to make more profits, so it will be perfect to say that it becomes synonymous with borrowing money from your future self. Because one way or the other, the debt will be nothing in comparison to the returns you make upon investments if taken out strategically. The first thing to do is understand the nuances of borrowing money or taking debt for that matter. Most importantly, you need to understand that not all debt should be labeled as bad debt. It might sound ridiculous at first, but the money you borrow to buy unnecessary things, expensive gadgets, or cars is bad debt. It will stretch you so thin financially that you will find it difficult to breathe under those piles of interest. Good debt will enable you to make more money, because let me surprise you, borrowing money grants you profitability as well as safety. As in, borrowing money and putting it to good, profitable use is way better than just buying stuff and owning it with no potential to grow. Now, this might seem to not make sense at first, as to why on earth would someone with deep pockets go ahead and borrow money when they do not even need it. So by the end of this video, you should walk away with a few good ideas where this would make perfect sense, as well as action steps you can take as well. Let me break down 4 different ways the wealthy use debt to get rich. Number 1, leverage. By leverage, I mean the borrowed capital for investment, with an expectation that the profits you will make will be greater than the interest payable. In plain words, leverage is a financial technique or a process where you borrow money to multiply or increase the return of an investment. It is mostly used by the wealthy, such as professional traders, entrepreneurs, and big investors. They tap into the borrowed money, for example, loans, securities, capital, or other assets, for an investment to increase the return of that investment. They use this money to buy more assets, hire more employees, or open new locations. For example, let's say you borrowed money from a bank with a 4% interest rate. Now you use this borrowed money to buy a house with a potential increase in its price over time. If everything goes as planned and your house generates more profit than the 4% interest rate, upon selling the house you can pay back the interest as well as invest in a new property with the help of the profit you made to generate more returns. Consider another example where you're investing $100 and expect a 10% return rate. If you are investing your own money, you will probably earn $10 outright. However, if you use half of your own and half from the debt money, you will make more money considering that the interest rate on the debt is less than 10%. Leveraging is a common practice amongst the wealthy at an individual as well as the corporate level. On the corporate level, the best example I can think of is that of Apple. Bill Gates borrowed money to manufacture his first 25 computers, and look where his company stands now. Commendable. On the downside, while leveraging can exponentially increase the returns, it can also compound your losses. There is always going to be a risk when trying to invest, no matter how calculated you are, and how foolproof your strategy is when investing. However, that's just part of the game. Sometimes if you want to gain some capital, you must be willing to put some of your skin in the game as well. Besides, this can only happen if your returns are smaller than the interest rate of your debt by the time you have to pay it back. So you can shoot your best shot by planning everything out beforehand so that you do not end up messing it up. Do not over-rely on such investments or you may end up losing more than you gain. The trick is to, what we call in a financial lingo, invest in loan when the return on investment of the loan is high and the risk level of the investment is low. Number 2, buying and selling stocks. Did you know that the stock market is full of wealthy people buying and selling stocks for earning profits and becoming even richer? First, let me explain how stocks work. Stocks are an extremely important constituent of an investor's portfolio. Public traded companies have a share in these stocks if they are listed on the stock exchange. So the question is, how do you use those stocks to generate returns? This is determined by the percentage of stocks you hold, the kind of industry you invest in, your risk tolerance, and profit goals. In the scenario of using debts to buy shares works, let's say you buy a share with the borrowed money. Compounding, or in other words, earning more than the interest rate, as mentioned earlier, would allow you to grow your investments exponentially. Upon selling the stock profitably, you can pay back the debt money as well as buy more stocks for long-term business. Now, the stock market may have its ups and downs, but no one can deny the fact that the market is ever booming over time, so there are high chances your profits increase if you are consistent and regular, taking advantage of the market dips and drops. You can buy a share at a low price from a company when it is going in loss and sell it at a higher rate when the business is back on track. Interestingly, you can not only buy and sell a stock, but also hold on to it and gain profits as long as the prices stay up. The wealthy do not ever buy stocks themselves. Instead, they count on financial professionals to chalk out special strategies to go about in terms of when to invest, expanding their portfolio, and cutting risks. The mistakes you need to avoid are lack of diversification, little to no concern for market timing, and emotional bias. The easiest way to go about doing this without doing too much research is just following the S&P 500. This is because it encapsulates over 500 of the tech companies right now and has enough diversification for it to be a safe bet. It's also been consistent with providing a 10% annual return, which is much better than if you were to go out and do the same on individual stocks. Number 3, real estate. Another way the wealthy use debt to get rich is the real estate business. You can either use cash to buy a property and become the owner right away, or borrow money like most people to buy a house over a mortgage. That property can then be used for two purposes: for selling it when its value increases, or by renting it out to get the profits pouring in around the year. The other people will be paying for your debts while you sit back and enjoy a financially stable lifestyle. For example, you buy a house with the borrowed money in a good location. After some reasonable developmental changes and renovation, you get your house reassessed and find out the market value of that house has boomed. Now you can resell that house with profit to buy another property. Let's say you buy a $100,000 house in cash and leverage it for returns that are greater than the interest rate. But what if I tell you that you can buy 3 different houses with that $100,000 you have? Surprised, right? You can go ahead and buy 3 different properties with the little money you have coupled with the debt money. This will have you gain profits from all those properties to pay back the loan as well as enjoy the stress-free returns. In simpler words, you never used money from your own pocket to get those profits. Real estate is full of loopholes. Almost anyone with the right amount of knowledge and experience can gain its benefits. All you need to do is keep your eyes peeled for when the market value of a property increases or decreases to buy and sell it at the right time and price. Moreover, the interest rates are also not the same throughout the year. A little research and you can get a loan with a small interest rate to invest in real estate. Real estate debt is the best thing to expand your passive income. So now is the time to diversify your assets. Make savvy, if not splashy, choices to place your chips. This takes us to the next way the wealthy use debt to get rich. Number 4, better cash flow management. Although typically considered a negative measure, the use of debt can be a positive one if it is used and managed correctly. There is a term used for acquiring and managing debt to gain profits known as cash flow management. In his book Rich Dad, Poor Dad, Robert Kiyosaki suggests that a house is a liability for the middle class or poor people. It is because of the house that most people loan money. They think of it as an asset, instead it turns into a liability. You earn from your job and send money back to the bank for the mortgage of your house. Here is when you're hit with the realization that there is no saving happening at all. On the other hand, when you use smart ways to utilize the debt and your income like the wealthy, the returns from assets go right into your pocket. What I'm trying to say is that the wealthy are better at managing their finances and cash flow and making investments. This is where you have the edge to make smart moves towards a financially stable future. Finally, I'd like to say that you should only take debt if you are intending to use it strategically for financial growth purposes. And if borrowing money does not do you any good, that means it is bad debt and you should avoid it at all costs. Hopefully, the video was informative and enjoyable. Don't forget to push the like button, and if you are new, subscribe and click the bell icon for more updates.